Hey everyone, welcome in to another daily editorial here on the KE Report. In this daily editorial, we are getting an update from Kuya Silver, traded on the CSE under the symbol KUYA and on the OTCQB under the symbol KUYAF. We are chatting with the president and CEO, David Stein. Now, we are going to be focusing a lot on the company's flagship, Bethania silver mine property. This is in central Peru. We're focusing here because the company did just release a PEA May 4th. This PEA encompasses the most recent resource that came in at just under 14 million ounces silver equivalent. Now, David, look, I'll post a link to the PEA news release because there is always a lot of data within a PEA and a lot of different points to highlight. I want to throw it over to you first, though. This is still a project that is fairly cheap to bring into production, generates some nice cash flow. I know some people are saying it is still a bit small, but I understand that there are some expansion opportunities here. What are some of the key points that you want to highlight within that PEA to kick us off here, please?
Sure. Thanks, Corey. Look, I mean, for us, the PEA has always really been just about the step one of developing Bethania, the first step, of what's going to be we think, a much larger silver project and silver mine, in the not too distant future. But that being said, we know that this is a very, economically viable, not just economically viable, but you could even maybe call it a cash cow. It's going to make a lot of money in production. And so for us, we felt like getting into production, even if it's a little on the smaller side, is going to be far more accretive for shareholders. And then we can, start allocating that cash flow into things like, expanding exploration, the next Bethania expansion to make it even bigger, et cetera, et cetera. So that's really been our strategy with this asset since day one. And I think the PEA, bottom line, is it kind of confirms much of what we had already been, talking about and expecting ourselves. For example, the costs, both capex and opex, are very, very low. That's what we always, had been thinking, and so it's nice to have some more firm numbers around that. Then the other thing that I think kind of sticks out at you in the PEA is how is the huge return and quick payback that this project has. So once it's financed and once it's in production, the cash flows that it generates, should basically pay back the capex in less than a year. And that's a fantastic position to be in. That just means that, again, more cash flow can go into more growth opportunities without having to constantly dilute shareholders. And I think that's, when you're owning a small company like ours, that's the biggest risk to shareholders is that unknown dilution. I think we can make the case that we're in a far better shape than most of our peers on that front.
Yeah, David, and with an IRR pre-tax of 227% or after-tax 188%, that's a big return on the investment. And initially it was a year, but you have a section here that, and I'd love you to unpack this a little bit, that deals with some pre-production toll milling that will bring in some money as you're building, and doing construction. And it actually shrinks the payback period down to 0.6 of a year. So it even shortens it some more there. So talk to us about how that part of the equation works.
Yeah, that was a little twist that our consultants started looking at on our behalf, and certainly on paper, it looks like it may be the right thing to do, especially in a really, kind of challenging market right here. I think if you're in a bull market and you've just got sort of unlimited or equity or very low cost of capital, then maybe you don't worry about the toll milling so much. But in our case, if the markets continue to be tough, which they may be, we have to prepare for that. Then what we have the option of doing here is over the first 6 months, because the underground mining will start about 6 months before the actual mill will be commissioned. So in that 6-month period, instead of just stockpiling that ore, we can actually go and toll mill it ourselves at another mine. Based on our assumptions in the PEA, we're making about 9 and change million of cash flow from selling that concentrate for that 6-month period, obviously while we're spending money at the same time to finish the mill. So it does enhance the payback, as you mentioned, and it is something that in this really difficult market that we're in, we'll have to look at very carefully.
David, can you break down the initial capex as well, coming in at 14.2 million plus a 25% contingency of 3.6 million. Where are some of the major costs within that capex, and just how insulated are you from continued rising costs, which we are seeing around the world?
Right. Yeah, that's the question everyone's asking. I think of all projects right now. I mean, the nice thing about ours is it's been costed relatively recently, so our costs are certainly up to date. Now, that being said, if things do keep rising even further from here, there may be an impact. But the one thing I would say is, when you're talking about call it ballpark $15 million capex, a 10% increase for us is 1.5 million. A 10% increase for $100 million project or multi-hundreds of million dollar projects is, you're starting to talk about big dollars that actually could make or break a financing. Whereas for us, I would say it's relatively immaterial. So we're in, that's another, great advantage of sort of building a smaller stage one project like we're doing and then expanding from cash flow, is that it does, I would say, insulate us somewhat from inflation. Getting back to your question, Corey, as you would expect, the process plant itself is the biggest component of that capex at about 6.6 million. And then the tailings facility, tailing storage, is about 3.2. So those two together, that's almost 10 million of the 14.2. And then the rest is underground mine development is a big one, and and then the surface infrastructure. The contingency is 3.6 million for that 26% or 25% that you mentioned.
Well, David, also walk us through, speaking of cost, what the all-in sustaining cost will be at the mine. I think it's a little different in year one versus the life of mine, but walk us through that, and then what the expected production profile will be.
Sure. So right now, the way the underground mine design has been done is we're mining a little higher grade in the first year, and the first 1.5 years, including the toll milling period. So that alone, just that higher grade, pushes the cost down a bit when you do look at it on a silver equivalent or per ounce basis. But regardless, even life of mine, they're still very low. You're looking at $12 all in, $10.50 in year one, and about $8.30 for the toll milling. That's per ounce of silver. So yeah, so that's sort of what it breaks down to. And again, it has more to do with the grade than anything else. The higher the grade, the lower the costs are going to be. And I think our grade assumptions in this PEA are extremely conservative. I think that's one thing that we internally will be looking at enhancing or optimizing as we over the next 6 months, as we do our own work and engineering on the project. We think we can do better than that. But anyway, that's what we've got right now. And even with those lower grades, it's still a highly robust project. So look, you're looking at producing a little over 1 million ounces a year of silver equivalent every year, with of course the first year being a little more than that. And that's again a big function of the grade. And the easiest way for us to enhance the production in the short term is going to be finding ways to mine higher grade, or schedule the mine in such a way that we can focus on some of those higher grade zones, because we know they're there in the mine. We've got lots of stopes that are going to be over 20 ounces per ton equivalent, which is much higher than our average head grade. So we'll see what we can do there to optimize that even further.
So, David, everybody wants to know then, what comes next? Do you guys move into construction, into mining here? Do you continue to grow this asset? Give us some insights into what the roadmap looks like from here now with the PEA behind you.
Well, I think the next big event for us is going to be, announcements relating to the project financing. And I think we can do something that's either not dilutive or maybe less dilutive than people are expecting. I think that could be a very, very positive surprise for the market here. And, we've been working on this behind the scenes for quite some number of months, because we've had really good information internally on the mine that we can share under NDA. So really no one's been waiting for this PEA, at least in terms of our our sort of potential financing partners. We've already been working with them for many months. So we're well advanced on that, and I think we can announce something on that, fairly soon. And that would at least convince the market that this project is going to get built, and then people can start to wave their arms about how much money we're going to make. And obviously once that job is taken care of, then we can see where we are in terms of how much additional exploration we want to do this year, next year, etc. But there's a lot of potential here to continue to do exploration and grow the resource, and that's something that we're committed to doing it. We want to do it, and we'll do as much as we can without, with obviously at the same time with, we have to be stewards of our capital structure and not just dilute shareholders for no good reason.
Well, David, let's dig in a little bit more to the potential exploration upside, just to give investors or potential investors an idea of how you could expand at both the Bethania silver mine area and also at your new target at Carmelita. There's 3 big veins running through your property, but you've got a lot of room to expand outside of the mineable area and keep drilling. Maybe just walk us through where you see the growth coming from.
Sure. So we've classed or subdivided we've got many veins at Bethania, but we've subdivided them into 3 vein systems that sort of seem to control the mineralization, and they're more or less subparallel to one another and run sort of east-west along the strike length of our property. And those vein systems are still open at depth and along strike. So the lowest hanging fruit for us for exploration is just to keep drilling the main Bethania zone at depth and along strike. And we have very good reason to believe that we're still very high up in the system, in the epithermal system here. So these veins could go hundreds of meters deeper. So for us to double the resource at depth is certainly not out of the question here. And to me, that's the that's the most logical place to go with our drilling. However, we are also really excited about the hilltop zone because we've had some spectacular results at surface. There's a whole new kind of cluster of veins there that seem to have a slightly different orientation to the main Bethania zone. They actually sort of run north and south and actually onto the new mineral claims that we just recently acquired as well. So we've got lots of room there, and I think ultimately the whole thing is going to be connected up together and part of one bigger system. So we're gonna have something that includes hilltop and the main Bethania zone and everything in between, and it should all connect up underneath the Bethania hill. So those 2 areas would be our number 1A and 1B in terms of our focus. And I think we've got potential to double, triple, quadruple the resource just without even leaving the Bethania mining concession. And then leaving the concession, obviously immediately to the north and south, we've got the potential extension of the hilltop veins. And then over 3 kilometers to the west, we've got the Carmelita mine, which looks like it could be a kind of a lookalike of Bethania, similar size, similar veins, was being mined at a small scale up until 2020. So we're quite excited about that, and we will be getting over there and doing some work on there very soon as well.
David, do you guys need any permits for any of the new drilling that's on tap or anything to continue that move towards production?
So in terms of building our mill and tailings, we do not need any more. We're fully permitted there. In terms of exploration, we went through the process last year. It did not. There is some reporting that you have to do to the government to sort of show what you're doing, and then that you reclaim your pads after you're done drilling. But it's not something that takes a lot of time, to be honest, because we have the mining concession. The permitting is pretty streamlined and seamless there, so it's not something that we're really that worried about.
Okay. David, thank you for addressing these questions. So I think that takes care of updating everybody on the PEA and what is coming next. If anybody has any follow-up questions for David regarding any of the work coming up from Kuya Silver or any follow-up questions on that PEA, please email us either fleck@kereport.com or shad@kereport.com. David, keep us up to date as things progress with the company, and we'll have you back on the show. Thank you again for your time. Hope you have a great rest of your week.